Nash joins us from FIIG Securities in Sydney. Stephen, good morning to you. How important an indicator is that as we try to gauge where our economy is sitting?
Look, I think it's very important to focus on these leading indicators. At the moment, I think the general consensus is that growth is a little bit lower than trend, and I think what markets are doing is looking forward to the budget and anticipating what the effects of a fiscal contraction will be on growth towards the end of the year. And I think the markets are increasingly focusing on the prospect of sort of sub-trend growth towards the end of the year.
So you're looking for what spending cuts by the government and how that filters through to the economy as an impact on GDP outlook?
Yeah, exactly. That's the general idea. I think the RBA minutes yesterday were important in the sense that they focused on the conservative consumer, which I think the market initially thought was going to be a transitory phenomenon, but I think recently the market's beginning to feel that that's a much more permanent situation. So we do have this sort of stagnant property market, we have a conservative consumer, and adding to that we're going to have a tight budget. So I think that's the general outlook. Now, with the Westpac indicator, I think the revision up was positive, but again, it's nothing really to get too excited about. I think the general outlook is focused on the effects of the budget.
So do you think that will be, I mean, the politicians always say tough but fair, but do you think it actually will be a tough budget?
Yeah, I think it will be, and the questions have been asked, well, why do they have to get this, why do they have to meet their promise and deliver the surplus? Well, I mean, one has to look to the European situation, and if a government doesn't deliver on its promises, it tends to get punished. And in the case of Australia, we haven't got a broader system to rely on. So I think the government has to be very conservative in the way it's managing finances right now. Governments can get punished very quickly by markets, and I think that's what they're trying to avoid.
But it's a vastly different situation. Well, obviously we know what's happening in Europe, but if the government was to say we can't return to that small surplus, it will be a small deficit. I mean, really, would the markets turn on the government?
Look, I think getting close to what they promised is probably good enough, yes. Look, I'm not saying that it has to be exact or anything like that, but a material difference and a material revision down and a material deterioration in the budget won't be viewed very well by financial markets, and I think that's the real point.
Okay, perfect. What about other leading indicators? We'll get a PPI, I think, Thursday. Is that expected to be influential?
Look, I'd say, unless it's outside the range, it really won't affect expectations of the forthcoming CPI. Now, in the minutes, the RBA did say that it expects that elevated fruit and vegetable prices will flow through, and that it's prepared to look through that number. I think also, in terms of the CPI, what we should be looking for is the effects of the higher Australian dollar in terms of its effect on retail pricing, and there may be some further deflationary impacts from the higher Aussie dollar in the figures. So I think we've got to look at the upside aspects, which are fruit and vegetables, and also the downside aspects, which would be these pricing effects from the higher Aussie dollar.
What are the markets telling us about the Standard & Poor's threat to the US credit rating that was issued yesterday, the warning that was issued? Does the market feel actually that policymakers in the United States will come to some kind of agreement about cutting the budget deficit and then stave off that threat?
Well, look, the US bond market has made a retracement of its previous losses, and I think for the time being that might be about it in terms of rallying in US debt. I think the likely outcome is continued wrangling between the various parties. Headlines like Republicans won't move or Democrats won't agree will basically come out, and I think will worry the bond market going forward. The equity market, I think, has shrugged the sentiment off for the time being, but I imagine it will be a theme for the next few months. And I think the problem is that this disagreement is costing the US taxpayer a lot of money, because there's a large issuance program going on, and I imagine that this disagreement is elevating bond yields by about 25 basis points or more. So when you're issuing 10-year bonds and billions of those, it costs you a lot of money, a lot more extra than it should.
Thank you so much, Stephen. Great to speak to you. Chat soon.
Thank you.
Thank you. Stephen Nash from